Welcome back to Money Pop. I think of myself as a fairly disciplined investor, and that discipline allows me to include gold as part of what I call my dry powder. I have already proven to myself during past liquidity crises that I'm capable of selling some gold when other assets become genuinely cheaper. So when I talk about liquidity, I'm referring to two things at once. I'm talking about short-term United States dollar-denominated liquidity, and I'm also talking about bullion. If you had asked me about this 2 years ago, I would have told you that my bullion would probably die with me and that the sell decision would be left in the hands of my heirs and successors. That has changed. Today, my bullion is forming part of my available liquidity. I'm not selling physical gold right now, but I'm prepared to sell physical gold if other asset classes become substantially cheaper during a liquidity-driven crisis. Many people who hold gold seem completely unwilling to sell it under any circumstance. And I simply want to point out that this rigid posture is not the only way to think about the metal. With the exception of very short-term commercial notes in my investment in Battle Bank, I no longer hold any bonds. I do roll short-term treasuries, but given my background as a credit analyst, I have participated for years in selective parts of the high yield and corporate market. And I have now exited those positions entirely. I cannot forecast the odds of a crisis with precision. What I do know is that the penalty for being wrong is extraordinary. I remember 2008 very well. The sales during that period were not made by individual investors. They were made by margin clerks, which meant that good companies, bad companies, and every company in between were forced lower. Because I entered 2008 fairly well capitalized, and because I had enough experience to act with courage, 2009 became the single best investment year of my career. This is not a forecast, but I believe the possibility of a similar decline is large enough that I'm building cash. I believe my sectors, natural resources, precious metals, and conventional financial services are not expensive relative to the broad markets. In fact, they are probably cheap, but I also know from past experience that in moments of panic, cheap or expensive does not matter. Any bid that appears gets hit. I want to be in a position to take advantage of that carnage if and when it arrives. Take Exxon as an example in oil and energy. It would be easy, and I know this will scare people, it would be easy for Exxon to fall from $175 or $180 down to $80 or $90. At the same time, I believe that by 2029, Exxon will likely be worth and trading at a substantial premium to its price today. The consequence of that view is that with my high-quality positions, I'm willing to wait it out. I see my downside as a question of duration rather than dimension. For the positions I was less confident in, the positions I held only because they yielded more than other savings products, meaning intermediate term bonds, I'm gone. The commodity I considered fairly priced is uranium. What I see as a highly likely outcome of the current conflict is a renewed appreciation of energy security. The only fuel in the world that is dense enough to provide real energy security for most countries is uranium. The Japanese made the point back in 1973 that one fairly small warehouse in Japan could store enough uranium to power Japanese industry for 5 years. You cannot store that much oil. You cannot store that much coal. I think the wind is genuinely in uranium sales now. It has moved from being a political pariah to being fairly well accepted politically. The irony is striking, but it is important to remember that both the French nuclear fleet, the fourth largest in the world, and the Japanese nuclear fleet, the third largest in the world, were originally established as a consequence of the energy instability created by the Arab oil embargo. That was a moment when low carbon fuel was not a preference, it was an absolute strategic necessity. I do not see how countries that are systemically energy short, places like Korea, Taiwan, Japan, and the People's Republic of China, can ignore the necessity of including more nuclear in their energy security mix. At the same time, the structure of the uranium market has shifted from one dependent on overnight spot sales to one increasingly dependent on term contracts. The term market itself is essential for financing nuclear plants. These plants require enormous amounts of capital, much of it debt capital, and lenders are increasingly requiring builders to lock in enough uranium under term contracts to substantially amortize the loan. This is a wonderful confluence of circumstances, and I think it benefits the uranium market for at least 10 years. You really have two simple choices if you do not want to do a great deal of homework. You can buy the Sprott Physical Uranium Trust. Full disclosure, I am the largest shareholder of Sprott. So if you participate, I indirectly benefit from management fees. You cannot buy physical uranium yourself and store it in your basement. You really should not even consider that. If you want exposure to physical uranium, which is probably the most direct way to play this story. Sprott is the vehicle. In the equities market, you essentially have one choice, Cameco. It has already had a real run, but it is, if you will, the ExxonMobil of the uranium business. If you are willing to take more political and social risk, you can buy the great Kazakh producer, Kazatomprom. I am not a buyer of Kazatomprom because I have observed defections of middle management staff there. I cannot explain it, but I'm afraid of it. So I would buy Cameco. The move from hated to tolerated is the easiest money in the world. When we first discussed uranium, the yellow cake price was about $30 a pound. It cost the industry $60 a pound to produce it. They sold it for $30, losing $30 a pound, and they did that around 150 million times a year. It takes a special kind of dumb to do that. At that point, either the price doubled to cover the industry's cost of capital or your lights went out. That trade is done. The easy money has been made. What remains in front of us is unique, both because of the increasing social and political acceptance of uranium and because of the new structure of the term market, along with the return of strategic considerations to the front of policymakers' minds. On the geopolitical side, there are several reasons the United Arab Emirates has been able to act independently. The country has greater fiscal flexibility than other OPEC members, including Saudi Arabia, thanks to its diverse economy. Part of it is also geology. Being upstream of Iranian production gives the Emirates more operational flexibility, and frankly, they have done a better job with energy infrastructure. As for political unity inside OPEC, it should be noted that OPEC countries are effectively at conflict with each other. Any suggestion of true political solidarity within OPEC is a non-starter. The Emirates, like the Saudis to some degree, also have the ability to transship oil away from the Strait of Hormuz. The idea that the Emirates should be constrained by Iranian aspirations ended the moment the rockets started flying. On the dollar for a practical period of time, say a decade, I believe the United States dollar maintains its global hegemony as the world's reserve currency. Trades that settle between oil producers and Chinese renminbi almost invariably get converted into dollars in order to be spent.